View on the Market, a practical view of today's financial markets. Unlock the potential of your portfolio performance by maximizing your investments. Learn how mutual funds, exchange-traded funds, and real estate investments can create diversification. View on the Market starts now.
And welcome to View on the Market. I'm your host, Jeff Zayas. And today we're going to discuss financial planning, why you need it, and possibly how that can help you in your retirement planning or just moving forward in your finances. And we decided to bring in one of our experts, Jim Dowd from North Capital Inc. Jim, how are you doing today?
I'm doing well, Jeff. Thanks. How are you?
I'm doing excellent as well. So why don't you tell us a little bit about your company and yourself personally?
Okay. So as you know, I'm a fee-only financial planner and registered investment advisor. And I've been working with clients, primarily individuals, families, and institutions for almost 28 years, working with them to solve their financial problems. And my firm now is really focused on doing two things. One is providing financial plans and investment counsel. And then second of all, managing portfolios for investors who would like to have discretionary investment management.
And what's the advantage of financial planning? Say for someone like myself who's close to retirement, what does your company actually do, and what should we look for when picking a financial planner?
Well, that's a good question. The first thing that people usually are interested in is being able to answer the question, do I have enough money and enough savings to be able to meet my investment goals? So a lot of times when people who are close to retirement come into our offices and are interested in speaking with a planner, it's because they're trying to understand kind of where they stand financially and whether or not they'll have enough assets to be able to last them through their retirement years. And so that's kind of usually the starting point. And then in addition to that, they're oftentimes looking for advice and help in actually managing their portfolio to generate the types of returns that they need to maintain the real purchasing power of their investment portfolios.
So do you kind of go through and look at their current net worth or their current investments and say how long you're going to live, and then how much you have to carry it forward to kind of figure this out? I mean, obviously you have to have some kind of number and some kind of criteria for that. So how do you actually do that a little bit?
So there are a number of factors that go into the planning process, and you mentioned a couple of them. One is how much you have in the way of investments right now, and the second is kind of we don't try to figure out how long you're going to live, but we do try to figure out how old you are right now, so that we can make some reasonable estimates of about what your time horizon is going to be, both from now until when you do retire, and then when you'll need those assets during retirement. So we try to understand your income expenses, your assets, and your liabilities. We also try to obtain some information and get some background about your personal experience with risk-taking, especially in financial markets, because it helps us to understand what type of risk tolerance you're likely to have as an investor.
So basically you kind of flesh out different questions to kind of figure out where they fall into different ideas, and then you help them come to the decision. But is it all based on can I live off of $70,000 a year when I retire going forward? Do I have enough money in my nest egg to kind of do that? Am I currently set up in the right sectors to ensure that to take place? Is that kind of part of the process?
Yeah, it's a pretty, I would say it's a fairly comprehensive process that considers all of those factors. I mean, certainly how much you're making and how much you're saving, what you're spending now and what you expect to spend in retirement. But it really goes beyond that. I mean, in addition to, just kind of considering the inputs and the outputs, we also look at the different types of accounts that are available for people to save for retirement, which accounts are most efficient from a tax standpoint, where in some cases there may be tax benefits for certain types of accounts that are available. And so we do a fairly comprehensive analysis of which accounts to use, which types of assets to put into which accounts, and then on the investment side, we do a lot of work on trying to determine an appropriate level of risk in the investment portfolio for people given their needs and goals.
So you mentioned before you're fee only. Can you kind of go through the different types of financial planners there are, so people can understand the difference between fee only and then possibly a percentage of the total portfolio to manage?
Sure. So in the U.S., unfortunately, there's really no kind of formal licensing requirement beyond kind of a basic state license or license with the SEC to be able to kind of hold yourself out as a financial expert, as a financial advisor. So there are a broad wide number of types of advisors that are out there who focus on certain areas, planning or just investment management, and there are different compensation schemes as well. And one of the ways that people have traditionally, that financial advisors have traditionally been compensated is through the commissions on the products that they sell. So most people are familiar with with kind of the brokerage market and sort of the traditional full service broker who is kind of selling particular products and particular funds, and typically the way that they're compensated for that is through a commission earned on the sale of those funds or on a trailer. In the fee only model, advisors are paid either an hourly based fee or an asset based fee, regardless of what the products are and regardless of what the advice is. And so it eliminates one of the conflicts of interest that is inherent in the business if you're kind of selling commission-based products to clients. It's sort of the old adage, never ask a barber if you need a haircut. By having a fee-only relationship, then you pretty much know that you're getting objective advice.
So you're trying to say that there's no conflict of interest for financial planning in advisors, and obviously fee only would be a better way of handling it. So if you are fee only, what is a typical fee?
So the average fee for most advisors is a little over 1%. That's been coming down in recent years. There's a fairly wide range. I mean, there are some advisors who charge 2% or more of the assets, depending on the quantity, depending on the value of the portfolio. And obviously, there's a kind of a time versus money trade-off that if someone has a very small portfolio, then the margin that needs to be charged to kind of make that account break even for the advisor becomes a higher amount. But there's a fairly wide range, but the average is right around 1%, and then it tends to drop for people with higher levels of assets.
So if you now, do you offer another service like where you you manage basically a portfolio for the client and actively trade it? When I say trade, I mean readjust the portfolio on say a quarterly basis or a monthly basis?
Yes, we do. So we again, and actively trading would not be the way to describe it, because we're not really trying to pick stocks or pick funds. We're really trying to allocate our clients' portfolios to a broadly diversified array of assets through funds and ETFs and other professionally managed products. But that's what we call discretionary asset management. So a lot of times when a client comes to us initially, their kind of first experience with them and their first experience with us is through financial planning. And then over time, once we kind of get to the sort of the final deliverable from that financial planning process, which is what the asset allocation ought to look like, then the client has kind of an option at that point to either self-direct their investments and to implement that asset allocation on their own, or to work with us or with another manager to implement and to manage that portfolio directly.
So discretionary accounts, is that based off the portfolio amount, or is it going to be again fee only?
Well, it's fee only in the sense that it's based on it's a fee that's paid by the advisor, and it's based on the value of the portfolio, but not based on the transaction volume. So we're not incentivized. There's no incentive for a fee only advisor to sort of push a particular product or to do more of something, to do more trading or more activity in the account. So that's really the primary distinction. And yes, for active management or for discretionary management, generally the model is an asset-based fee.
And then what about the how often do you, not you, but what do you suggest rebalancing the account? When do you revisit it? I mean, if you're not to trade on an active basis, but do you do it every 3 months, every 6 months, or is it event driven by different markets falling apart or something like that, or is it all above?
It's really kind of all of the above. I mean, there's no sort of set rebalancing kind of frequency. It's not like we come in on the Wednesday of every third Wednesday of every quarter and say, okay, today's rebalancing day. It's more dynamic than that. We're looking at our clients' portfolios all the time. I mean, we pretty much are in tune with what's going on in the markets and are in tune with what's going on in the funds that are in our clients' portfolios. And as market conditions necessitate, either because a particular asset class has outperformed or underperformed another, or where our market view has changed and we're either trying to take risk out of the portfolio or add risk to it, for strategic or in rare cases for tactical reasons, then we can make that change to the portfolio. As an example, we will tend to do a rebalancing, in the fall for almost all of our accounts to take advantage of tax loss harvesting, which is where we go into taxable accounts and sell positions that have paper losses in order to realize that loss, which then can be written off against people's ordinary taxes up to $3,000. So that's something we do every fall, whether or not the portfolio needs rebalancing or not.
Well, I have no losses in my accounts, so it's a moot point for me. Of course, we do know I do like Bank of America. I'll say that again, Bank of America stock. So I got one last question. And it's just not mid cap and different sectors. You also probably do you think about like the global market as well? Different markets in overseas and different growth markets over there.
We do. Our clients' portfolios are very broadly diversified. In a typical investor's portfolio, they might have a portion of their portfolio that's allocated to U.S. stocks and probably a portion that's allocated to bonds. And for our clients' portfolios, we're first of all we're looking much further than the U.S. stock market for equity returns. We're allocating to global markets and we're allocating to emerging markets within that. So the portfolios of our clients tend to be more broadly diversified than the portfolios of sort of a typical U.S. investor. And then we're also looking at what I call sort of the minor asset classes, which are risk-based asset classes that are tend to be overlooked in traditional plans. So things like master limited partnerships and REITs, real estate investment trusts. We also look at high yield and floating rate bonds. So we're trying to kind of look anywhere we can to find a source of return that either reduces risk in our clients' portfolios or increases return for the same level of risk. And
one last question, because you mentioned the word return. Would it be feasible to say under a well-balanced portfolio, 4.5% to 6.5% would be an average return, or how would you in today's market? Because right now, obviously, the market is just doing great, for some people, anyways. What do you think is a reasonable return on investment on say just like a mid-level risk aversion? Would it be 6%, 4%, 5%? What would you think would it be?
It's really difficult to say. I mean, we generally try to benchmark the expected return for each of the asset classes that we invest in, that we allocate to, based on kind of the prevailing interest rate environment, and then we kind of go from there. So in the environment that we have right now, really the givens that we have are, where long-term interest rates are, where short-term interest rates are, kind of around 2% on the long end and much less in the short end. And then our expectations about inflation and some general market expectations about kind of the returns for risk assets like equities. So, 5% is certainly a more reasonable target than, say, 10% or 7%, which, some institutional investors still believe they can achieve kind of on a consistent basis. I mean, for our planning purposes, we generally target a 5% pre-tax return, which we, believe is a prudent level for long-term investing. Although, as we say with all of our clients, returns are not guaranteed, and there's always risk in any investment that you make.
Yes, that is true. My Herbalife stock is just not doing that well right now. Inside joke. How can people reach you in case they're interested in getting your services?
So we have a website, northcapital.com, or certainly people can contact me through LinkedIn. It's James Dowd, but the website's probably the easiest. We have a contact form there, and we work with people throughout the Bay Area and across the United States. So happy to kind of answer any specific questions that people may have and address any items that kind of come up just to kind of make that introduction.
Okay, and we'll put a link to your website on our website. So, Jim, thank you so much for being on View on the Market, and hopefully we can do this again.
Great, thank you, Jeff.
Okay, take care.
This program is for educational purposes only. The opinions expressed are not intended to be and should not be considered financial advice. Viewers are encouraged to consult with their financial advisors, tax preparers, or other professional advisors to evaluate their personal circumstances.